Hi, and welcome to this finance lecture for Stockholm Business School. My name is Anders, and I will talk about investment decisions, and more specifically bonds and bond valuation or bond pricing. First, however, as usual, we have some repetition to do. We said that financial decisions is about giving up resources today in the hope of obtaining something good in the future, typically money. So in order to compare the money we pay today to the money we get in the future, we introduced time value of money, where we said that money today is better than money in the future due to inflation, interest rates, and some risk or uncertainty. We provided you with some formulas for calculating future and present values. I will not go through them now, but you can see previous lectures. And we also introduced the present value of an annuity, where we said that an annuity is a cash flow stream with equally big cash flows, and that has exactly one period between every cash flow, typically years or half years or something. And the present value of such an annuity is the cash flow divided by the interest rate times the factor here, which is 1 minus 1 divided by 1 plus the interest rate raised to the power of n, where n is the amount of cash flows. And here is the notation as you will see in the formula sheet. And now we will talk about bonds. A bond is a debt instrument in which one party, it is a corporation, municipality, or a government, raise money from investors today in exchange for promised future payments, which is called coupons. And I mean, this sounds pretty much like the investment decisions as we talked about earlier. We as investors give up resources today. We pay the bond or buys the bond in order to get future payments or something good in the future. In this case, the cash flows that the bond will give us, or in bond terms, the coupon payments. The bond contract specifies a coupon rate and a face value, which in turn determines the coupons, or the payments we receive. Coupons are the fixed principal that investors receive periodically until the maturity date of the bond. When the bond matures, the investor usually also receives the face value. This contract is offered to the market. The investors that are willing to pay the most for the contract determines the price of the bond, or the market price. You can see the market as some kind of auction. All financial instruments are basically sold via the market auction, where if you're willing to pay more than someone else, you will get the instrument, in this case the bond. So some terminology for bonds. The face value, or sometimes called the principal, denoted FV, is the nominal value usually received when the bond matures, and it determines, together with the coupon rate, the coupons or interest payments that are received periodically through the life of the bond. And the coupon rate determines, together with the face value, the coupon or interest payment. The coupon payment, which I've talked about, is the interest payment received periodically. So if you enter the bond contract, you will get paid some amount, typically every half year or so, semi-annually. In this course, often annually, so once a year, but it can be something else as well. And we calculate the coupon payment as we multiply the coupon rate with the face value, and then we divide by the number of coupon payments per year. So if it's semi-annually, it's 2. If it's annually, it's 1. And I think that is the two cases you need to remember in this course, but of course it's not hard to, if it's 4 times here, it's just to divide by 4. Same logic. The term of the bond is the time remaining until the bond expires. The maturity date is the day or the date when the bond matures or expires, and usually when the face value is paid to the investors. The discount rate is the rate at which we discount the future payments, just as before when we calculated net present values. We use a discount rate to discount the money till today. And the yield to maturity. The yield to maturity is the discount rate that sets the present value of the bond payments equal to the market price. So you can say that it's some kind of market discount rate. It's the discount rate that the market have used to price the bond. We also have something called par, which is when the bond is traded at a price equal to the face value. And this happens when the yield to maturity is equal to the coupon rate, or when, yes. Also have discount, which is when the bond is traded at a price below the face value. And this happens when the yield to maturity is greater than the coupon rate. And it can be traded to a premium, which then is if the bond is traded at a price above the market price, or above the face value. And this happens when the yield to maturity is below the coupon rate. We can describe a bond with the timeline just as we do with regular NPV calculations, where we as investors pay something today, we pay a price today in order to receive the future payments, coupons and the face value. And it could look like this, for example. So this would be a 5-year coupon bond. So we pay the price of the bond today and we receive the coupon payment every year for 5 years, and the 5th year we also get paid the face value. So when we determine the value of the bond, we discount the future cash flows we will receive, just as we have done with the NPV calculations. So we move this back till today. The simplest form of bond, or the simplest kind of bond, is a zero coupon bond, which basically is a bond without coupon payments. It only pays out the face value. So the price of such a bond is then the present value of that payment. So for example, if you have a bond a zero coupon bond for 3 years, you will be paid the face value in 3 years. In order to price the bond, you just calculate the present value of this cash flow. And it looks like this. It's just as net present value, just that this here, yield to maturity, was called R before in the NPV calculations, and here the face value was called C. So if you see it as C divided by 1 plus R raised to the power of n. It should be a capital N. This is exactly what you did before. But when we price bonds, we call the cash flow here that we will receive the face value if it's a zero coupon bond, and the discount rate are called the yield to maturity. Otherwise, it's exactly the same thing. Yeah, and N is the term of the bond. So if it's 4 years until maturity, hence we get the face value in 4 years' time, then N is 4 because we will move it 4 years. A coupon bond, on the other hand, pays the investor coupon payments of some periodicity. In this course, often once a year, but in reality, often twice a year. The price of such a bond is the present value of the payments, again, but here's the coupon payments and the face value, discounted with the yield to maturity. And for some reason they call yield to maturity as a small y instead of YTM when it's a coupon bond. I mean, it doesn't matter, you can call it whatever you like. But the formula, if you say so, looks like this. And perhaps this looks very hard. It's hard to get. It's long and it's a bit complicated perhaps. But you will see that it's not that bad. So we can, the formula calculates the present value of the bond. I think I've said that. But we can split it up into two parts. We can first look at this part of the formula, the first part. We take the coupon payments and discount till today, using the present value of an annuity formula as we have done before. So we take the cash flow, in this case CPN or coupon payment, we multiply with 1 divided by the discount rate, in this case yield to maturity, and the factor 1 minus 1 divided by 1 plus the interest rate or yield to maturity, raised to the power of n, which is the amount of cash flows or amount of coupon payments. In this case it's 1, 2, 3, 4, 5. So n is 5. And the second part, this one here, well, it's the present value of the face value, and it's just as when you calculated the present value of a single cash flow. The cash flow here is called face value, and you discount it with the interest rate or yield to maturity, and you raise this with n, which is the amount of years we want to move it. So in this case you receive the face value in year 5, so n is 5. You move it 5 years. And together it's like this. So take one formula at a time if it seems hard, but it's just combining two of the formulas we have used before. So let's take an example. What is the price of a 4-year zero coupon bond with a face value of $1,000 if the yield to maturity is 6%? Well, we can look at this as a cash flow stream or a timeline where we pay something today, the price of the bond, and receive something in the future, the face value. In order to price it, we discount it till today, just as we usually do. And the formula for this is as follows. You take the cash flow we will receive, here called the face value. We divide it by 1 plus the interest rate that we want to discount this cash flow with, which in this case is called the yield to maturity. And we raise this to the power of n, which is the amount of years we want to move the cash flow. Since it's in 4 years' time, n is 4. And if we calculate it, we get the price of 792.094. So if we should take another example, a bit more advanced at least, and then we have the same example, but we also get a coupon payment every year. And we know that the face value is $1,000, and we also now know that the coupon rate is 5%. So, and we should still assume that the yield to maturity is 6%. So in order to get the coupon payment I showed you before, it's the coupon rate times the face value divided by the number of coupons payments per year. The coupon rate was 5%, the face value was 1,000, and it's once a year, so it's 50. So we get 50 every year, and we get some face value in year 4. So in order to calculate the price of the bond, we discount the coupon payments, and since the coupon payments are an annuity, we can use the present value of an annuity formula, where Y here is yield to maturity, or what you usually say the discount rate, and N is the amount of cash flows. This example, it's 4 cash flows. And last, we take the face value, which is a single cash flow, and since it's a single cash flow, we just divide it by 1 plus the interest rate, or here the yield to maturity, raised to the power of 4 in this case, since it's 4 years. Just have to clean up a bit. And you will get this price, 965.349. And we can also now conclude that this bond is traded to a discount, since the price is smaller than the face value. And as we said before, it's because the discount rate is greater than the coupon rate. So to summarize, a bond is a debt instrument in which one party, a corporation, municipality or government, raise money from investors today in exchange for promised future payments, which we call coupons, and the face value. And in a timeline, it could be represented like this. You get some coupon payments and you get a face value. And for this, you are willing to pay the present value of these coupons or of these cash flows. And you also get a formula for this. It's basically you use 2 formulas. You use the formula for a present value of an annuity, and you use the formula for present value of a single cash flow combined. And that was all for today. Thank you very much.